There we go. Good afternoon, everybody. David here. Welcome to the weekly education session, Wednesday, 20th of May, 2015. The topic for today's weekly education session is that of position sizing. It's a topic that is central to your trading. Obviously, risk management is first and foremost, and we generally learn that through hard-earned experiences in the marketplace. Certainly position sizing is the key to keeping your position sizes relevant and making sure that you're not risking too much capital in the market. So we've got to have some strategies for how we actually calculate our position sizing, and that's the topic of today's webinar. Alright, first, the disclaimer that the content of this session or any other Elite Traders Club session is purely for educational purposes and is not to be construed as financial advice. So please consult with your licensed authority before making any decisions based on the general advice presented in any of the ETC presentations. Alright, the agenda, as you can see it there on the screen today, is capital management. That includes position sizing. We're also going to be talking about notional capital and what that means and how to calculate it, and then we'll finish up with a recap at the end. Right, capital management. Why is it so important? By now, most of you would have seen this particular slide, and it just shows us the impact of suffering a drawdown somewhere along the way. So the example there, if we happen to have a drawdown of 10%, to get back to break even, our starting amount of capital, we actually have to generate an 11% return on the capital that we've got left just to get back to break even. If we happen to experience a drawdown of 20%, then we need to make 25% on the funds we've got left just to get back to break even. 30%, we've got to make a 43% return to get back to break even. Once we start getting into 40 and 50%, which is what a lot of people suffered during the GFC, we've got to start making some serious money just to get back to break even. So it's really difficult to try and make those returns back, at the rate at which you lost the capital. During the GFC, those 50% drawdowns, 40% drawdowns that a lot of people experienced really occurred over about a 12-month period. So to try and get that capital back to make 100% on what you've got left is pretty difficult. There have been certainly some stocks over the last few years that would have helped you get back to those particular levels, but the typical retail investor, mum and dads, are typically looking at their 4 banks, which have done pretty well, but then they're looking at at Woolworths and Wesfarmers, a couple of other retail stocks, etc. along the way, a few miners, BHP, etc. And they're certainly nowhere near back to where they should be. So certainly capital management is extremely important. It's one of the technical things that you do need to actually learn, because if we lose too much, it just becomes really difficult to get it back. Right, why is it so important? Obviously, the emotional side of our investing and trading is something that we all have to deal with. Some of us are better at dealing with it than others. We typically don't make good investing decisions when we're under stress. A little bit of stress has proven to be beneficial for us, but certainly when it comes to financial stress, it's very uncomfortable, and a lot of people, when they're under financial stress, tend to revert back to old habits and sit on their hands and do nothing, and that's probably the worst thing to do. So obviously making sure that we have our exits already planned before we get into our trades is really important, and making sure that when we do take those exits that we don't donate too much capital to the markets. So there's 2 ways that we look after our capital when we're investing and trading. The 2 elements, basically, the first side of it is individual trade management, which we're going to talk about today. So it's from that perspective, we're talking about the use of stop losses, because stop losses help us to define our risk. On the basis of that risk that we've chosen to accept, we then go through and work out our position size, or that percentage value at risk that we need to have on every single trade. Now, this is all in your trading plans, and it's an essential part of your individual trade management. The other aspect of trade management, which we won't cover today, is managing portfolio risk. Now that's equally as important. So we're not just keeping an eye on individual trades, but we're actually keeping an eye across our entire portfolio to make sure that we're not exposing too much of our overall capital to the market under any set of market conditions. So that's a topic for another day. Today the focus is on position sizing. So individual trade management. The first thing that we need to do when we're thinking about taking our positions is to determine the individual position size. So when you first start Elite Traders Club, you were given a big survey to complete, around about 60 odd questions, and then after that you have a post-survey interview with one of your trading coaches to determine the level of risk that you're comfortable taking on your individual trades. Now for some of you that could be anywhere between potentially 0.25% up to maybe 2%, depending on how much capital you've got. Typically we encourage people to be at the lower end of the spectrum, and somewhere down around about 0.5% I think is adequate. Certainly this is going to depend on the amount of capital that you have. So we need to establish what that percentage risk is for each trade, and then we also need to establish what that dollar amount is. So a little formula there on the screen, it just says that the dollar amount that we're going to risk is based on our percentage risk for the individual trade, and we multiply that by the amount of available capital, and that's effectively what notional capital means. Notional capital, it's used to determine the dollar risk on the next trade. So it represents the total available capital that you've got in your account less the value at risk on your open trades. So the next trade, the dollar risk that we're going to take on that trade is simply the notional capital that we have available multiplied by our percentage risk. So let's go and have a bit of a look at the definition of value at risk. This is the definition straight out of your trading plan. It's the amount of capital at risk on a trade where that stop loss has yet to be trailed to break even or better. So basically it's the amount that's blowing out there in the wind, if you like, that the market could take. Certainly once your stops have been trailed to break even, then you're reducing obviously the amount of risk that you have in the market, and that's a good thing. That's our first objective when we're trading, is to try and get those stops trailed to break even or better, and that way the chances of the market taking more money from us than what we want is greatly reduced. Alright, so capital management. If we're having a look at our particular example, and here I've just touched on the element of portfolio risk there, assuming that we are in a low risk market and our trading plan says that we're allowed to have a maximum of 15% value at risk across our portfolio, I've put up some conditions. Assuming that we have an account balance of $215,000 and the current value at risk that we have on our open trades in the market is $15,000, and we're allowed to risk 1% of our account value on each trade, what is the amount of capital that we're allowed to risk on our next trade? Well, if we have a look there, the dollar amount that we're allowed to risk is our percentage VAR multiplied by our notional capital. Well, what's our notional capital in this case? It's our account balance, $215,000, less the value at risk on the open trades. So that means that we have got $215,000 minus our $15,000 gives us a balance of $200,000. Okay, so $200,000 in this case is our notional capital. We have a percentage risk of 1%, So 1% of that notional capital, that $200,000, is $2,000. So we're allowed to risk $2,000 on the next trade. So given that we're allowed to risk $2,000, how do I work out my position size? The sleep at night factor. And you'll see the little guy there in bed, and up on the ceiling it says, if you can read this, you are risking too much on your trades. So if you've ever been awake at night or you can't sleep, you're worried about the market, it would tend to suggest that you've probably got too much risk. So perhaps exposing a bit too much capital, and that's a sure sign of why you're not sleeping well. So we're allowed to risk $2,000 in this particular example. So to work out the number of shares that I'm allowed to purchase, my dollar risk there is $2,000. Now from this figure I have to deduct my commissions. Now the commissions obviously are going to involve brokerage on the way in and brokerage on the way out. So as the example, I'm going to suggest that we are paying brokerage of around $30 in and $30 out. And the other part of the equation is I need to know what my stop distance is. So it happens to be a Monday morning, you've just watched the weekly analysis session, and we've got a stock that's been suggested by myself, or perhaps one that you've come up through with your own particular scans, and we have to work out exactly what our position size is, the number of shares. So the entry price suggested by yours truly on a stock is $38.54. That's the entry price, and the stop on that particular equity is $35.68. It's actually one from this week's list. Our brokerage cost in and out is around $60. So from that point of view, our amount of capital that we can risk is $2,000. From that we have to deduct our brokerage. So there's $60 of brokerage there, so we deduct that from our capital that we're allowed to risk. The stop loss distance, the difference between our entry price of $38.54 and the stop loss at $35.68 is $2.86. So once we've done those sums, we end up with $1,940 divided by $2.86, and the answer comes out at 678. So that means that we're allowed to purchase 678 shares in this particular example. Each one of those has $2.86 of risk on it. So that multiplied together, then including your brokerage, gives us a total amount of risk of $2,000. Now that's a simple example of how to do position sizing. Now most of you should also have the trade journal. If you don't have a copy of the trade journal, send us a note and we'll send you out a copy. You can actually download it from the Elite Wealth website, and we can give you a tutorial on how to use the position size calculator. But what the position size calculator is very good for doing is helping you to calculate your overall position size. It actually goes through and calculates for you your notional capital, which is very handy, and adjusts your position size taking into account your brokerage. And for those of you that are also trading CFDs, it takes into account your finance costs as well. Now that's, your finance costs are going to depend on how long you keep your trades open for. Obviously the cost of financing has come down over the last few years as interest rates have come down as well. So again, if you need a hand with the trade journal, then give us a call, and we'll coach you through that so that you're comfortable working out your position sizing. Alright, so that's basically the mechanics of going through and working out your position sizing. It's not a terribly difficult concept once you understand how to do it. The place where most people get a little bit tricked is just working out their notional capital. So just remember that your notional capital is just the amount of available capital that you've got in your portfolio. So effectively it's your account balance less any value at risk on those open trades. Okay, so a quick summary for today. Just make sure that you know your percentage VARP, so that's your value at risk limits for your entire portfolio. That's in your trading plan. For most clients it tends to be somewhere between about 10 and 15%. So that's across your portfolio. You should also know off the top of your head the individual risk that you're allowed per trade, and again that should be somewhere between around 0.5% to around about 1%. Alright, so once we know those figures, then we just need to convert that percentage amount to a dollar amount, again based on our notional capital. Then just take into account from that figure our brokerage and financing if you're using CFDs, and then just simply divide that amount by your stop distance, and that will produce your position sizing. So that's it for today, guys. A pretty short and sharp education session. If you've got any suggestions for next week, certainly let us know. Some of the topics that I will be covering over the next month do include the relative strength comparison and some research on that. That's been pretty well documented in a number of scientific papers. Some webinar material, some educational material on psychology. I've had a few clients that are certainly dealing with a few struggles, the mental aspects of their trading. Some people will find that a bigger obstacle than others. It's something that you certainly do need to work at. So that's another suggestion for topics coming up. If you would like a session on the Trade Journal, don't forget to click on the emails that we send out and register a call for your trading coach, and we'll help you with that. We've had quite a number of clients that have also rung through and made requests to get their scans and beyond charts updated. So that's the loose scan that has the confirming candle. We've had quite a few clients that have done that. I've got a question there from David. Do you have an update on the ETF strategy? I'm right in the middle of writing the very first article for that, David. I'm hoping to get that out this Friday. There'll be a series of 4 consecutive articles going out on Fridays before we officially launch the ETF strategy at the end of June. So certainly it's there. It's just a matter of laying the groundwork, and then we will certainly release it, and we'll run a webinar explaining exactly how the ETF strategy works, its results over history, and how you can get involved with that as well. Peter, I've got a question here. Do you put these pages up to print out? You mean, Peter, the pages on the from the webinar, I'm assuming? Certainly, if you want to shoot me an email, I can provide you copies of these. More than happy to do that. The actual calculations, etc., they're all in your trading plan. So have a bit of a flick through your trading plan, and you should see those contained within. Certainly the trading plan document, it's a big document, but it's certainly got a lot of valuable information in it. But I'm happy to provide these slides in case you'd like them. That's fine, Peter. Right, very good. Well, look, don't forget the recorded macroeconomic session that we're doing on Friday afternoons. Hopefully you're getting some value out of that, and you can listen to it over the course of the weekend before the live session on Monday morning. So good luck with your trading between now and then, and we'll catch you bright and early 9 AM on Monday. Thanks, folks.